Hey everyone, I've got a lot of questions about Sentinel One. So in this video, I'm going to evaluate Sentinel One stock and answer if I think the stock is a buy, hold, or a sell. Now, if you've been following my channel, you'll know that cybersecurity is one of my favorite markets to invest in. I see this as a growth industry for not only the next decade, but 2 decades or more. We're spending more and more of our time online, on digital services, on digital devices, and that's creating an increasing need for cybersecurity, especially the type of endpoint cybersecurity that Sentinel One offers, protecting devices, logins, etc. So let's take a closer look at this cybersecurity stock and answer if I think it's an excellent stock to buy right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So investors in Sentinel One stock are likely disappointed because the stock price is down to $29.15, down from the highs of around $70, $80 per share earlier in 2021, although the stock price is recovering nicely from the bottoms around 2023. Still, investors are hoping for more growth from Sentinel One. Now, one thing that has continued robustly is Sentinel One's revenue growth at 573 million in the most recent trailing 12-month period. That's up from around 140 million in 2021. I expect this company to continue growing for several years more, and so do analysts on Wall Street. Now, beyond the next few years, I think it's got growth potential for the next decade or more. Cybersecurity is a quickly growing market, and that's not even highlighting one of the opportunities I think in cybersecurity, which is a better login process. Right now, the login process with multiple stage logins and, put your password in, get the notification, log this in, did that. Logins are becoming longer and more sophisticated, getting in the way of user experience. Now, if any of these cybersecurity companies can solve that and make it easier to log in again, where you're not having to take multiple steps and get multiple notifications to log in and making it more secure at the same time, that's an opportunity for growth as well. So I like this industry. I think it's got several years, perhaps several decades of growth ahead. And I'm a fan of cybersecurity stocks to be sure. That being said, Sentinel One is losing a lot of money on the bottom line, negative 68.56% operating profit margin to be precise. The good news is that it is making progress towards profitability. Its operating profit margin, although negative, is heading towards profitability. It is making progress towards profitability, which is something I do like to see when a company is negative in terms of operating profit, to at least demonstrate to me that you're making progress, you're on your way towards profitability, and Sentinel One is certainly doing that. Now, looking forward over the next 2 or 3 years, it's got excellent top line prospects ahead. For its fiscal year 2024, analysts expect 32.4% revenue growth from Sentinel One, and then another 31% growth in fiscal year 2025. Although what you do notice over the last 3 years is going to be decelerating revenue growth, meaning the growth rate is slowing down. The rate of growth is slowing down from 46% in 2023 down to 32 and then down to 31% in 2025. The good news is that investors do expect Sentinel One to achieve profitability on the bottom line sometime next year, and then grow from there. So it's demonstrating significant improvement and progress towards profitability. Now, in terms of cash flow from operations, I want you to look at why that's important. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Okay, so now that you understand this metric, you can see it is negative again at 14.7% negative, but again making progress towards profitability, towards positive cash flow from operations, negative 14.7%. And then finally, I want you to look closer at the price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. All right, so you can see Sentinel One forward price to sales ratio of 8.17, near the cheapest it has been going back several years. Remember, it was trading at a forward price to sales near 50. So I understand the company has excellent prospects. The industry has excellent prospects. However, I don't think the company is far enough along in terms of profitability and cash flow to justify paying such a premium valuation. A forward price to sales of 8.17 is not cheap at all. It's not cheap. So for those reasons, I would say Sentinel One stock is still a hold for now. I'll be watching this one closely to see how much progress it makes towards profitability. I wouldn't be surprised if I upgrade this stock towards the end of 2024, although for now, I'm keeping the stock rated as a hold. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.